input costs and weak overall market sentiment have led the stock prices of some of the fundamentally strong auto ancillary companies plummet quite a lot, giving favorable risk-reward to investors. And one such company is Ceat, whose stock price has corrected by more than 40% from its high in Feb 2021, making the valuations look extremely attractive for the company. Now, this coupled with strong demand scenario from OEMs and aftermarket make us upbeat about the company. One of the biggest concerns for the company has been the rising input costs. Natural rubber and crude derivatives are the two most important raw materials for tire companies. Though natural rubber prices remain stable over the last 1 year, what's hurt the company the most is a significant rise in crude prices. Crude has risen by as much as 60% in the last 1 year, impacting the company's margins. Crude prices in last few days softened due to release of US strategic reserves and the absence of the feared oil and gas sanctions on Russia. However, global oil market is estimated to be in deficit anywhere between 1 and 2.5 million barrels a day by the end of calendar year 22. Therefore, crude is expected to hover around $100 a barrel this year. However, the company has chalked out plans to bring the margins back to 12 to 14% range. It's currently focusing on expanding exports mix to 25% versus current level of 18 to 20%, driven by truck radial tire launch for EU in the next 4 to 6 months, healthy growth in EU passenger car segment, and through expanding highway truck mix to 10% versus 5% currently. Around 45% of Ceat's revenue comes from the CV segment, which has been doing exceptionally well, as is evident from the monthly wholesale numbers of OEMs. With the opening up of the broader economy and increase in the pace of economic activities, the demand for trucks has risen significantly. The government's focus on construction, infrastructure, mining, all of that is expected to boost demand. In addition to trucks, the bus segment is also expected to do well with the opening up of schools, colleges, and offices. The outlook for truck segment, which makes up 15% of the total revenue, is also promising with higher sowing of the rabi crop this year, good level of water reservoirs, increased union budget allocations to rural and agri sector, and the initial indication of a normal monsoon this year. Now, two-wheelers, three-wheelers and passenger car segment, which contribute around 40% of the revenue, have been facing challenges due to semiconductor shortage. However, the supply shortage is easing and OEM production is rising. Demand outlook for these segments from medium to long term is encouraging, driven by a broader recovery in the economic activity. The reopening of educational institutions, offices after 2 years is expected to drive demand for two-wheelers as well as PVs. Moreover, the upcoming monsoon is projected to be normal. Higher crop production and a positive rural sentiment are some of the factors that are expected to keep demand for two-wheelers and PVs buoyant. Overall, the sentiment is very positive for the next fiscal. Ceat has identified two-wheelers, passenger car and OTR tire segments as strategic focus areas where they can improve margins and reduce dependence on the truck segment. Over the last few years, contribution from these segments has improved quite a bit. In fact, the gains are visible in terms of market share as well. PV segment market share is at 15% right now compared to 11% a few years back. According to the management, with the current CAPEX plan, they want to ramp up these segments to contribute around 60 to 65%, which is expected to improve margin profile for the company. Replacement demand continues to do well for the company. It grew 14% year-on-year in Q3 FY22. Post-COVID, the increase in economic activities and free movement of vehicles are expected to boost replacement demand as well. We believe that 40% correction in the stock price from its high achieved in Feb 21 has captured the challenges that the company is facing. And current valuation of 13 times FY23 projected earnings provides favorable risk-reward to investors. Of course, a slow recovery in demand could hurt financial, so potential risk to watch out for. Additionally, adverse commodity price movements would increase raw material costs and therefore hurt operating profitability.